Well, the big beautiful bill is in effect, and there are new tax deductions and strategies that you need to implement by year end if you want write-offs and savings in 2025. In today's video, I'm going to go over 3 strategies that are critical for year end and that are renewed or new under the big beautiful bill. Also, I'm going to hit 8 other year end strategies that you must implement by December 31st if you want them saving you money on your taxes in 2025. All right, let's start with the first one here. This is bonus depreciation. It is back at 100%. What does this mean? If you're buying equipment or a vehicle in your business, you need to do it by December 31st, 2025. You could be using a loan to be purchasing this equipment. It does not have to be a cash outlay. Now, bonus depreciation, what that means is certain assets that are equipment, you typically don't get to write them off entirely in the first year you acquire it. So let's say you bought some piece of equipment in your business for, let's say, $10,000. Well, generally the IRS says you don't get to take 100% value of that deduction in the year you acquired that equipment. Instead, you take it over time. So for example, this piece of equipment might have a 5-year life. The IRS is going to make you take $2,000 every year as a write-off. Even though I may have bought the thing and spent $10,000, I actually only get to take a $2,000 deduction every year. I'm going to take that over the next 5 years. So eventually I'll get the $10,000 write-off. Well, we don't like that. We don't want to wait to take the write-off and deduction. We want to write off everything now. I want tax deductions and tax savings now. That's what bonus depreciation lets you do. It lets you accelerate that and take 100% of the depreciation in the year you acquire the equipment or vehicle, whatever it may be. And by the way, if the big beautiful bill did not pass, you would not get 100% depreciation and write-off in year 1. You would only get 40%. So it's a huge change in benefit because of the big beautiful bill. Now, if you have no reason to buy an equipment or vehicle in your business, don't do it. Don't just waste money to get a deduction. But if this is otherwise something on your list, let's get it done before year end and not wait until 2026 in January, February to acquire that equipment and wait a whole nother year to get the value and benefit of the deduction. All right, number 2 from the big beautiful bill is the state tax deduction workaround. Under our federal tax code, individual taxpayers are limited on how much state income tax they can take as a deduction. Now that used to be $10,000. If you paid state income tax, you could only take a federal income tax deduction of $10,000 that you paid to the state. So this is the state income tax deduction you get when you itemize your deductions on your federal tax return. Now, under the big beautiful bill, the state income tax deduction was raised from $10,000 to $40,000. So now you have up to $40,000 in state taxes that if you pay, this could be property taxes or income taxes, you're paying to a state or local government, you get to take a deduction against your federal income taxes. But let's say you made $1 million, just so I can do the math here, and let's say you paid $100,000 in state and local tax. Well, under the new big beautiful bill, you get to take a deduction of $40,000 against your federal income. So now I'm taxed if I made $960,000, but I paid $100,000. I'm getting taxed on this $60,000 by the federal government that I had to send to the state. I didn't even get to use that money or enjoy it. Well, this is where the state income tax deduction workaround comes in. Some people call it the SALT workaround. Now, if you're a business owner, what you're able to do in most states is pay your state taxes from your S corporation or from your business. This is for pass-through entities like LLC, partnerships, or S corporations. And I would pay that $100,000 to the state. Then I actually get a $100,000 deduction because it came from the business, not from me personally. Now I get credit with the state. I did pay the tax. They have the taxable income. I get a deduction on my federal tax return for the full $100,000. Okay, this was something hotly debated at the end of the big beautiful bill because business owners were frustrated that they were getting taxed on income that they were making, but they actually had to send to the states. Now, in the big corporate scheme and corporate C corporations and large corporations, they're deducting without limitation their state taxes that they're paying against their federal income. So this was kind of the compromise. Hey, small business owners, they get taxed at the individual level. And when we put a cap here, they can only take a deduction of, let's say, $40,000. That penalizes kind of these medium-sized business owners against large business owners. This is the workaround. You can pay it from your corporation, your S corporation, or your partnership LLC, even your sole proprietorship, to the state. Pay it from the company. Every state has a little different procedure on how you need to do this, but you need to do that by year end. So if you're someone who is high income, where you're paying more than $40,000 in state income taxes or any state or local taxes combined, you want to make sure you understand this SALT deduction workaround so that you don't hit the cap and you get the maximum deduction possible on the state and local taxes you're paying. All right, number 3 here, and you've heard this one many times from many different people, buy real estate. Okay, I want to break this down for you because there's 3 scenarios here. And and it's not as easy as some people say. Now, the first here, if you're just buying a single family rental, buy and hold real estate, you've got a business or a day job, you're not in the real estate industry, buying a rental property this year doesn't really help you on your 2025 taxes. Rental real estate's tax advantaged, right? I can be cash flowing this property, putting money in my pocket, it's appreciating over time, and I've got all the deductions on the property, including depreciation, without even doing anything like a cost segregation, just regular depreciation. It's offsetting the rental income, so I'm not paying taxes on the income. So that's good. I like that, but that's not helping me against my other income. If I've got a large W-2 or I've got a successful business, buying rental real estate, particularly long-term, does not help me. But what a lot of people are trying to do is they're trying to get deductions now in 2025 to offset other income that they have. They're not just trying to get tax-efficient income in the future like you can get with a long-term rental. They're like, Matt, how can I buy real estate now and get a bunch of losses to offset other income? Well, you have two options there. First is the short-term rental. If it makes sense to buy a short-term rental for cash flow and investment purposes, and you would do it anyways, you might as well do it by year end. Now, to qualify as a short-term rental where you can take all the losses of this property, you can do a cost segregation, bonus depreciation, let's get a ton of losses out of this. You get over $100,000 loss, $200,000 losses we're seeing with clients doing the short-term rental loophole, and they only are buying the property for $200,000 or $300,000, all right? So there could be some big losses that you can take to offset other income. So if I qualify for this short-term rental loophole, it's called the -9 election. You got to have material participation, 100 hours. You've actually got to be involved in this thing. But if you can do that by year end, now I can take the losses on this property that could be significant, use those losses now to offset my high income W-2 or maybe my business income. So that's one area where I can take these passive real estate losses, typically move them over to actually offset ordinary income or business income that I might have. Now, the second option here is the self-rental rule. If you want to acquire real estate that you lease to your business, let's say you're the dentist, for example, and you're currently leasing the office that your dental practice is in, why don't you go buy an office, whether it's a condominiumized office spot or a separate building, whatever it may be, and then that LLC that you have, that you acquire that commercial real estate in, is going to lease the property back to your dental practice. Now, under the self-rental rule, where you're renting your own real estate, and this is a separate entity for asset protection, over to your dental practice here, and this is just a dental example, this could be any business, but now I'm able to take the rental real estate losses from that property, the commercial real estate rental, against my business income. So for any of you business owners that have thought about acquiring your own office location or store or retail or warehouse, whatever it may be in your business, this is one where you can take those losses from that real estate and offset your other income. But if I want it for 2025, I've got to do it here by year end. And because of all this bonus depreciation, all this acceleration we can do with cost segregation, this has now become much more powerful because of the big, beautiful bill. All right, now I'm just going to be hitting some strategies here that are critical things to do at year end if you want to make your tax return and your tax bill as low as possible. Next thing here, tax loss harvesting. I want you thinking about crypto here for a second. Crypto is currently down at the time. Who knows by the time you watch this video where the pricing it was at, but it went from 126,000 per BTC down to like 90,000 per BTC. So if you're someone that bought up when it was high at 120 grand, and now it's sitting at 90, you can sell that crypto right now and get a $30,000 loss, and then repurchase the crypto 1 minute later because you still believe in Bitcoin and think it's going to go up over time and you want to ride it back up. But I can lock in that loss immediately now. Now, typically with stocks, when you're buying and trading stock, you can't sell a stock at a loss and immediately repurchase. There's something called the wash sell rule that makes you wait a whole month. So under the wash sell rule, when you're selling stocks for a loss, which maybe you bought Nvidia or some of these AI stocks that have currently reset right now as I'm shooting the video, you could sell any of your stocks that have gone down in value and lock in the loss. But when you're selling stocks and trying to grab a loss out of them, you can't rebuy that same stock within a certain window, typically 30 days. So with crypto, there's no wash sell. I can immediately rebuy, so I have no risk of losing out on that asset that I typically believed in and may have wanted to stay in for the long haul. But with stock, publicly traded stock, the rule is different. You do have to wait a year. You could rebuy into some other asset, even a similar company, but it needs to be a separate stock, can't be the same ticker. So that's a big item here, some tax loss harvesting at the end of the year. Don't just think about it for your stocks. I want you thinking about it for your stock portfolio. We can use those losses to offset other gains. Even if you push forward into another year, great. There's no cost to you to lock in the loss. But for you crypto investors, this is one of the recent moments where you can lock in a loss right now. Prices are actually down, so you might as well because there's no wash sell rule. It costs you nothing besides the trade. Good opportunity to lock in some losses. Those losses losses, by the way, can offset other crypto gains you may have now. Or if you don't have any for this year and you're just locking in a bunch of losses, they move forward to later years and carry forward. You will eventually use those losses to offset future gains when you're selling and taking gains and money off the table. All right, next here is the retro S election. For any of you business owners, maybe you've been an LLC taxed as a sole proprietorship this year. Hey, sorry to cut in here. I just want to make sure you know of my law firm, KKOS Lawyers, where we help clients across the country save on taxes, protect their assets, and plan their estates. Get over to KKOSlawyers.com to learn more. We'd love to be of assistance to you. Now back to the video. One thing you may want to do is if you make more than $50,000 of net income, we're looking at the year here, looking backwards, what was my income? What was my expenses? If you have more than $50,000 of net income, you will save taxes by doing an S corporation rather than being taxed as a sole proprietorship. So if you're just an LLC and maybe this is your first or second or third year of business, whatever it is, and you haven't done this S election and done an S corporation, by the way, we love that strategy. I've got another video on that here you can watch on the S Corp strategy. But if you've never heard of this strategy, I'm going to explain it here briefly. When you make money as a sole proprietor, let's just say you're an LLC, you never made an S election, it just goes on to Schedule C on your tax return, very common for a lot of new business owners. What you're doing is you're paying tax on your income that you make, that's income tax. You're also paying self-employment tax, that's Medicare and Social Security, it's 15.3%. So for example, if you had $100K of net income on your Schedule C for your self-employment, you're going to pay $15,300 in self-employment tax. If you had $50K, you're going to be paying $7,600, okay, half of that. So that percentage that you're paying is self-employment tax. But in an S corporation, you are allowed to pay yourself a salary of what's coming out of the S corporation and a dividend or profit. The whole reason you do an S corporation is to pay yourself net profit or dividend because that is exempt from self-employment tax. You only have to pay self-employment tax on the salary coming out of an S corp. So let's look at someone that has $100K of net income, for example. I might pay myself $50,000 as salary, and I'll take the other $50,000 out as net profit or dividend. I pay no taxes on the net profit or dividend coming out of the S corporation at 15.3% on $50,000. That's saving me $7,500. So if you're in this situation and you want to get that into effect for 2025, you've got to act now. You can make an S election back to December 31st for the year. But the reason this is important now is you need to start doing payroll. You need to do a fourth quarter payroll. You need to do a W-2 at year end. So this is something you've got to take into action now if you want to on your 2025 return. All right, next, for any of you brand new business owners that have some expenses, you've been doing training, you have some inventory, you have some costs, some website, whatever it is that you've set up to get the business going, but you have not made a sale yet. You will not be able to use those expenses. You need to get out of startup mode. You need one customer. Sell somebody your product. Sell somebody your service, your aunt, your friend from high school. I don't care who it is. Get your first customer and get going and get out of startup mode because now those expenses can be used to offset income. I can't take those expenses. I can't use them against other income. They're bottled up and they carry forward because I'm in startup mode. You've got to get a sale to get out of startup mode so you can unlock those expenses and use them on your 2025 return. So for anybody new that have not made a sale yet, get out of startup mode, make your first sale. Now I'm just going to keep flowing with the ideas here. And I know they don't work for everybody. Not every one of these might work, but maybe one or two of them work for you. But it can mean thousands, if not tens of thousands of dollars of savings on your tax return. So hang in there with me here. Okay, next idea. Again, any of you business owners, hold your annual board meeting. Do you have a board of directors for your corporation or a board of advisors for your LLC that you can just establish easily in the minutes with your LLC? Hold your annual meeting. Maybe these are your friends, your family members, the people you talk about your business. Have an official meeting, an agenda. Talk about the business. Get your input. Being a business owner is lonely. Let's get the input from this, make it a little more official. We can write off their travel. We can write off expenses for the meeting. This is your opportunity to do it at year end. Maybe have turkey. I don't know. But think about the year end board meeting. Break time to do it. Get it done before December 31st. All right, next, any of you that got kids with a business, this could be a rental property. Your kids mow the lawn out. I did that for my dad when I was a kid. I mowed the lawn at his duplex. So did my brothers. Maybe you have an operational business or an office. My kids would come and clean the office every weekend at our law firm. I was paying them to do that. Why would you pay your kids in your business besides teaching them about money and the value of hard work? Because you will save taxes. Now, for any of your kids that are under age 18, you can pay them from a family management company. This can be a sole proprietorship or an LLC. If it's your rental property LLC, you can pay them right out of the LLC, and you can pay them up to $15,750. This is the standard deduction, where they won't even need to file a tax return or claim it as income. So that's pretty freaking awesome because you just got a $15,750 deduction. Now, they would need to have done work that was of that value. Maybe they only did work that was worth $5,000 of value through the year. I don't know. It depends on the situation, what the work that your kids are actually doing and the true value of that. But we know we can get up to $15,750. But remember, you're getting deduction. This is reducing your taxable income at a 37% federal tax bracket, and your kids are picking it up at a 0% tax bracket because they're under the standard deduction. Now, let's just take this to the next level. Rather than giving your kids that money and having them blow it, why don't we put it into a Roth IRA for them? Because now they have actual earned income. We can put up to $7,000 a year into a Roth IRA for them. We call it a kids Roth IRA. And we do them at our company, Directed IRA. They can invest it in crypto. They can invest it into real estate, other private assets. They can buy stock with it. Whatever they want, we do it at Directed IRA and do these kids Roth IRAs. And by the way, when you're paying them from your LLC, family management company, or your LLC rental property, there's no W-2 you need to issue. Any of you S corporation owners, okay, we will not pay them directly out of the S corp. We will instead have the S corp pay a family management company, and you will pay the kids from the family management company. This family management company is just a sole prop. It'll go on Schedule C. It's a very simple entity providing services to your S corp. There's just some snags when you're trying to pay your kids directly out of an S corp. So we like to do them out of an LLC, whether it's a partnership or a sole proprietorship or a simple family management company. It simply just has a bank account, receives income, pays the kids. You get the deduction. The kids pick this up as income, but remember, they don't have to file a tax return if they're under the standard deduction. And if you want to take it next level, put the money in a kid's Roth IRA for them, teach them the value of investing. Let's see what this account looks like in 10, 20 years. They will be the geniuses of the ones who started with the Roth IRA in their teenage years or earlier, depending on the age of your kids. All right, now the next strategy, any of you self-employed with no employees, maybe you're a consultant, a real estate agent, you're self-employed, you have business income, but you don't have other employees. Maybe it's just your partners or family. Well, you can do something called a solo 401k. This is a 401k for a self-employed person. And what the IRS has said is you don't have to do this big complicated 401k with matching for employees and all this stuff and all this testing, formality. You can do something simple because it's just you, business owner. We want you to have a 401k. You can put in $70,000 a year for 2025 of 401k contributions. That you could do all traditional dollars if you wanted, and you can get a $70,000 deduction in 2025. Now, you could also do Roth dollars, which is great. I got $70,000 of Roth dollars growing and coming out tax-free. Remember, I don't get a tax deduction. That doesn't help me in 2025. I'll be loving it in the future because that money's growing and coming out tax-free, but didn't help me in 2025. So if I'm chasing deductions for 2025, you may want to do traditional contributions. You must have the plan set up by year end in order to maximize all of the deductions and contribution options. So solo 401ks, we set those up in my law firm at KKOS Lawyers. We set them up at Directed IRA as well. We've helped thousands of clients use these solo 401ks. Great for you that are self-employed with no other employees. It's the best retirement account option for anyone in that scenario. If you are self-employed, but you have employees that work for you, you're going to do the regular 401k structure, maybe a safe harbor 401k. There's some other options there, but the solo K is a powerful one. Get it done before year end. No employees other than business partners or other family members that work in the business. Number one account strategy for you. Now, since we're talking about retirement accounts, I had to throw in Roth conversions here. So if you have traditional IRA or 401k dollars, remember, this is growing and you're not paying taxes as you're building that wealth in the traditional account. But when you start pulling that money out of retirement, you're taxed on the way out. However, you can convert those traditional dollars to Roth dollars. We have lots of clients that move over to Roth because they want to grow and that money to come out entirely tax-free later on in retirement. To do a Roth conversion, though, the downside is, let's say I have a $100,000 IRA I want to convert to Roth IRA dollars. Well, I'm going to have to take $100,000 into income. Your IRA custodian, whether that's us at Directed IRA or Fidelity or whoever your retirement account provider is, you do a Roth conversion, they send you a 1099 January of next year that says, hey, you have $100,000 of income and you have to claim that on your tax return. So if I converted $100,000, let's say I'm at a 30% federal tax bracket, maybe I'm at a 5% state, so I've got a total of 42% in tax. Now I have to pay $42,000 to the federal government and state government because I did that Roth conversion. And that sucks, but that whole $100K is now Roth dollars. It's going to grow and come out tax-free later at retirement. If I can turn that $100,000 into $500,000 or $1 million, now that amount is coming out entirely tax-free later on. I had to pay my $42,000 now, and that's short-term pain. Trust me, I don't want you you to pay taxes if you don't have to, but that hurts and is the cost to go to Roth. But the upside is you have long-term gain, because now if that turns into $1 million over the next 20 years as I'm growing it, which is possible, now as I'm pulling out $1 million, I have zero tax. But if I left that as traditional dollars and I pulled $1 million out, that would be $420,000 in tax to the federal and state government. So the benefit, of course, here is I'm paying tax on the seed here, not on the harvest. Downside is it's now, but the benefit of the Roth conversion is I'm growing and the money's coming out entirely tax-free. Now, another year-end strategy to think about is rather than converting the whole $100K all in 2025, maybe you do $50,000 in 2025 and then $50,000 on January 1st of 2026. That way you've broken up the conversion to 2 tax years. Sometimes you'll jump to the next tax bracket that can be a 10 or 12% jump in brackets by doing a large conversion. So depending on where you are on income and the tax brackets in your situation, it's strategic to convert a portion now and a portion next year, or even do it in thirds over 3 years so you're not pressed into that next tax bracket. Not for everyone, but just an idea here. Think about that. We call that Roth chunking by taking the conversion over multiple years and spreading out the tax burden. Another idea to think about is we're at year end here. Maybe I just want to convert the whole thing in January of 2026, and I'll worry about this on my 2026 tax return rather than worry about it in 2025. So that could be another approach to take, push this into the next tax year so I don't have to worry about it until 2026. All right, last but not least here is being strategic about your charitable contributions. If you're giving to your church or charitable causes you believe in, you've got to do that by year end if you want the deduction in 2025. And a couple other strategies I want you to think about within there. The first, if you have appreciated assets, let's say this is stock or real estate, whatever it might be, you can donate the appreciated asset to a charity or church, wherever this might be in your scenario, and you don't have to pay the gain on that, plus you get the charitable deduction. So for example, let's say that I bought $100,000 of Apple stock that's now worth $300,000. I've held it over time and it's now worth $300,000. But I really want to make a $300,000 charitable contribution to the charity that I believe in. Well, don't sell that $300,000 worth of stock. Pay taxes on a $200,000 gain, which would be federal long-term rate of 20%. Let's say 5% in your state, 25% on 200 grand. That's 50 grand in taxes I'm going to be paying. Instead, I can send the whole 300 grand to the charitable organization. They sell the stock, pay no tax on it. I get a deduction of the $300,000. Okay, this is what a lot of wealthy people do is they're making charitable contributions. They contribute assets and they let the charitable organization sell the asset, get the money. This is a way for you to give more value to the charitable organizations and less to the IRS and to the state. So this is donating an appreciated asset. You get to take the charitable deduction at the fair market value. The charitable organization sells it. They pay no tax on the gain because they're a charitable organization and they get the full value of that asset. So win for you, win for the charity, lose for the IRS. That's a great strategy. Remember that for your charitable contributions. Now, I hope this list gave you 1 or 2 great ideas that you can use by year end to lower your tax bill. And if you want a comprehensive tax and business consult where we review your prior tax return, your specific situation, my law firm KKOS Lawyers does that for clients every day across the country. Small business owners, people with a side hustle, big business owners, doesn't matter. We can go over the strategies that make sense in your specific situation and help you with the tax implementation plan and the diagram. We call it a trifecta to get you organized and get it into action. And if you found this helpful, if there's one strategy there that you can use, please at least subscribe to the channel. I'll give you more, I promise. A lot of strategies on building wealth, saving taxes, protecting your assets. I'm Matt Sorensen. We'll see you next time.